Hello and welcome to session 13 of our Series 7 exam overviews, brought to you once again by Passing Score, where you can get more help on your finance exams at PassingScoreFinance.com. In this video, we'll be going over government bonds, also known as Treasuries, Govies, or more generally as sovereign debt. Treasury naming goes by the maturity length of the issuance. So bonds have 10 years or longer maturity. Notes are issuances between 2 and 10 years, and Treasury bills have 1 year or less maturities. These are sold at a discount, with the full face amount being paid at the maturity date. There's different types of treasuries, including strips, in which the interest and principal amounts of an issuance have been separated and sold to investors. TIPS offer inflation protection for investors by an adjustment on the face value depending on changes on the CPI, and we'll see a little bit more about that in just a second. Cash management bills are short-term funding needed by the Fed, which are usually just handled by institutional investors. TIPS, as we saw, offer inflation protection, and their adjustments are made to the face value twice a year. In our example here, we can see a 1% CPI increase is multiplied times the face value to get $1,010, which will be paid at the maturity date. The positive about this is that if there's deflation or decreases in the CPI, the face value won't fall below $1,000. So you get the protection from inflation without having to pay the risk of a deflationary cycle. Savings bonds are issuances made for retail investors, individuals. These include Series EE, Series HH, and Series I, which works very similar to the TIPS we just saw, offering inflation protection. And similar again, it does that twice a year based on the CPI change. The tax treatment of treasuries is especially attractive to investors since they're exempt from state and local taxes. Generally, the remaining federal tax is due if there's an interest payment or upon maturity, as we can see for the different bonds here. The Fed issues its treasuries through auctions that it holds several times throughout the year. On Mondays, it issues 3-month and 6-month T-bills. Tuesdays, 4-week and 1-year T-bills, and those are both issued on Thursdays. Monthly, it issues the 2-year and 3-year Treasury notes, and those are issued at the end of the month. Remember these timings because these kind of details can show up on the exam. For longer term maturities, 5-year notes, for example, are issued quarterly, and it's usually February, May, August, and November. For the longest maturities, the 30-year treasuries, those are issued semi-annually, and again, usually February and August. In both of these cases, the issuance is done on the 15th of the month. So again, remember these details for the exam. Accrued interest is when a buyer buys a bond in between interest payments. So they'll have to pay the interest earned by the seller up to that point. U.S. bonds use the actual day count to calculate their interest, and corporates, on the other hand, use a 360-day year for their interest day counts. Treasuries are offered using different kinds of bidding mechanisms. Competitive tenders are for large institutional investors, and the highest bidder gets the securities. Otherwise, the Treasury also uses, or the Fed also uses non-competitive tenders. And one example of this is a Dutch auction in which several investors are submitting bids. And let's take a look at how that works here. In a Dutch auction, you have several people submitting a bid, and in this case, we have 1 million shares that are being offered by 4 different bidders here that we can see the prices for. Now, the first 3 bidders add up to 250,000 plus 560,000 is 810,000, with the remaining 190,000 offered by the by bidder number 3, and he's offering $44.90. So that lowest bidder that still fulfills the total shares that are being offered is the price at which everybody will pay, or I should say the first 3 bidders will pay for the shares. The 4th bidder, he's beyond the 1 million shares that are being offered. And his price has come in too low to be included in the first million shares, so he won't get any shares. Bidder 1 will receive 250,000 shares, bidder 2 will receive 560,000 shares, and bidder 3 will receive the remaining 190,000 shares to round out the million share offering. In any case, all of the bidders will pay the $44.90 price, which is the lowest acceptable bid to meet the share requirement. That's it for our Dutch auctions explanation and for our government bonds section. If you have any questions, please feel free to email me at john@passingscorefinance.com, and good luck on your exam.